What's going on, Goodies family? We are finally at part 4 of the Market Profile series, and today we're talking about retracement programs. This is IPTA, state of delivery where prices in a minor pullback or a change in direction just short term, okay? So a day trader needs to be taking profit at previous day lows and highs because order flow can kick in at any point, and we always want to minimize our overall trading risk, okay? In this video, I'm going to show you how I enter the market using retracement program strategies, okay? So it's going to be very simple. Without further ado, let's get right into it.
Let's go.
Daily. So what we want to do is point out what area of price we're going to be focusing on, because obviously we're not going to look at every price leg here. You only need to use one price leg to understand what's going to happen in the majority of most retracement programs. Okay, so what I'm going to do is outline the area of price where we're going to be focusing on, which is going to be from this area on to the right. The reason why we're going to be using all of this left side of the chart information is just to look at the liquidity generated at the lows. Okay, keep it very simple. So if we look at the most recent low ran as this low, and this low ran that low, and then this low ran that low, and ultimately this run on liquidity here ran this low. So ultimately you can say that from this price leg up onwards we had a rejection block to this low. Price is clearly creating support. A lot of retail traders making a lot of money off these triple bottoms here. Okay, so what I'm going to do now is put on the sell side liquidity that was taken, and then we'll move forward in the video. Okay, here we have two lines that I put on the chart. One is this area here, and you see I put a drip here. This is liquidity. Okay, and then ultimately these are the sell stops of the price leg that brought price into a premium. The reason why I have two areas of price is to give you two examples of what a retracement is going to look like. Okay, when price was coming down from this high all the way down to this low that ran these equal lows here, what did price do? It immediately pulled back and gave you a nice 10 days or so of bullish price action to the upside, right? But what happened once price came up to this high here? They created equal highs, right? This in the retail world is considered a double top, and a lot of retail traders are getting involved in this area here. They're looking at this as, well, price came to the zone and shorted, okay? And that it did short there, but it wasn't on the premise of this retail zone here. It was on the premise of this last down move before this upside that traded into this fair value gap. Once price traded into this fair value gap, it dropped down and we had resistance here, and price pulls back where? Into the mitigation block, redistributes again, leaving fair value, right? Notice how the fair value gap is where they always reach for when they get to a discount, and then they redistribute and run these equal lows. Once they do this, what we see in the market is a short-term retracement back to the upside, meaning as day traders, this is a swing low. It's valid. You've already taken the first 3 parts of this course in the Market Profile series, understanding how you can get into this reversal pattern and continuation here. But what I'm telling you today is this is actually a retracement, because the order flow from this high all the way down to this low is quite bearish. And as you can see, all of the liquidity ran on these lows here is another signal of being bearish. So what happens? Price goes into a retracement, and what we would be looking at is these equal highs for it to run. But the moment that it doesn't run these equal highs, you have your array here, your premium array, which is this mitigation block. A mitigation block is very simple. We'll discuss it in later parts of the course, but I'll tell you right now, it is a swing point, or a bullish order block in this case, that fails to run a high but then immediately runs the low of that original buy signal here. Okay, so you have that down candle, pushes up into the gap, right? Did it take out a high? No, it did not. Pushes down and runs the original buying point here. That's a mitigation block, simply explained. So in this area right here, we would be buying the retracement but taking profit at previous day highs every single day, because we do not know if it's going to just trade to the premium level of this civvy. We don't know if it's just going to trade to the premium level of this civvy here, and we don't need to know. We just need to understand what we need to do if price fails to trade above this high or above this civvy premium level. Okay, so moving forward, price does what from here? It runs down and runs the liquidity, and this brings us into our current example now that I'm going to go into the intraday timeframes and explain. Okay, so before I even go into the intraday timeframes, what I want to show you guys is, again, the fair value gaps. We're going to outline all of the ones that I've talked about so far. I want you guys to study these fair value gaps. Once price trades into them, they're not just done. This is now going to be your new resistance and or support. If price breaks above it, it's considered balanced price range, and then they're creating support and the market goes up. If price fails to break above it, it's considered resistance, and now we should see a break and retest off of the fair value gap levels. You'll see swing points form at these levels. Okay, I don't want to give you a mouthful of information. It's still the same stuff. Swing points at premium and discount levels with present arrays is basically how we trade at Good Eats. We don't need to make it complicated. All right, so now that we said everything, let's zoom in. We understand what's going on in the market here. At this point, prices already ran all stops. We go into a consolidation. What happens here? We get a nice little smart money reversal, don't we? Right? Get this low, right? And get down here. And then we get this nice little buy signal here. Right? This is where our retracement is. This is our low risk buy. Well, Christian, why is this our low risk buy? It's very simple. I have a very, very nice strategy that I'm going to put on the screen on how I like to trade the retracement. Okay, so let me go ahead and put that on the screen for you guys. Okay, here's the strategy. All right, strong up candle, right, or down candle. In this case, it's a strong down candle with an impulsive move to the upside that gives a market structure shift or break a structure with displacement. You see how it ran these highs? That is displacement. Okay, remember, in the market, three things are always going to be happening: liquidity, imbalance, and rebalance. That is literally the key to IPTA, is understanding that this is how price is booked in the market. So when I give you a strategy like this, this is an algorithmic signature, okay? We want to see this happen. This strong down candle before an aggressive up move, running stops, breaking structure, right? This is displacement. You see how it leaves fair value? That's why I marked this fair value gap. Once it leaves this fair value, we're waiting for a retest of that fair value gap present, which is this area here. That's why this is a low risk buy. Now, a lot of this stuff is just like what we were talking about in reversal market profiles. That's true, but that's why I saved this video for last in the market profile series. It's because we're taking everything we learn and we're applying it and understanding how do we know that we're likely in a retracement market profile. Well, as I said before, if the price came from this aggressive up candle before this down move that created displacement here, it's the same exact story. We have an imbalance, right? And then we have a rebalance when price comes back to the premium. So all of this price action, this 1, 2, 3, 4, 5, 6 days, 7 days before it makes a swing high, is all a retracement. This is 1 week of pulling back. Let's put the week separators on there and see. As you can see, this 1 week open, went down, created a strong down candle. The displacement, low of the week, was formed on Monday, right? Price runs the stops, and then the next couple of days, you notice the momentum on these candles. They do what they need to do. They run previous day high. This day is an inside day. This day runs previous day high. But ultimately, to come back into the liquidity pool here at fair value. And then what happens the next day? Boom, price runs up. So when you see people getting into these entries on Mondays, and you're like, oh, I don't trade Mondays, I'm sitting out. The only time that it's high probability to trade Mondays is when you know that the price action from previous day is with the narrative that you have for the following week. So in this week, coming into it, I would have been anticipating to fill this gap. I don't know that it's going to fill it on Monday. It could have filled it Tuesday or Wednesday. But the point is, until this gap is filled, price will continue to rebalance this imbalance. And once this is rebalanced, this all becomes a balanced price range. And what you want to see is price create a swing point at this equilibrium or consequent encroachment, or you want to see it run these stops and turtle soup short. And that's what we get in the following week. And we're going to go through the price action on the intraday timeframes, and I'll show you exactly how this retracement worked up to this point and how we could have taken advantage of it. And then we'll actually go through this area here and how price then breaks structure back down to this order block, getting buyers into the market thinking, oh, well, I know smart money. It came back to this order block, so it's buying, buying, buying. As a matter of fact, look at the body closes. Where is it closing at? The discount level of this SIBI here. When you start seeing this happen, you have to understand that we have a large up candle with major displacement, right, to the downside, running stops. Did it leave a fair value gap? Not on the daily. This is when you need to go down to your lower time frame to see it. But ultimately, do you even need to? No, because you have this balanced price range here and a strong order block formed right there. Price is failing to break above. What are we doing now? We're not in a retracement market profile anymore. This is a consolidation where we're shorting at the premium end of the consolidation with this fair value gap here being the resistance. And that week, what happens? You're shorting every single high and the premium array here. You have a bearish order block and you have this balanced price range from this SIBI. So all week shorting. Then look, small retracement. So if you don't understand what retracements are by now, go back and watch the video again, because what I'm telling you is when you have institutional sponsorship, you see that price is delivering from this swing high where this last up candle came from all the way down to swing low. We get a small little reversal, we get a pullback into a premium array, and price is literally failing to trade above this array. We get a strong bearish order block forming here. We get resistance at the discount level of the SIBI. We get a drop and a run on buy stops again. You have to understand that going into this week, this order block right here is now a propulsion block. You have one order block, two order blocks, three order blocks. You have three bearish order blocks all stacking. That is a propulsion block. It's two order blocks stacked on each other. In this case, it's to the downside. So you have nested arrays with this overall resistance from the SIBI. Price comes into the premium, fills the high of this bearish order block and taps the SIBI one last time at the discount level, and what happens? Sinks with major displacement. Major displacement. What I want you to notice is that before price actually delivered to the upside, they made sure to clear the sell stops. So you should have been anticipating that. No, this is a swing low forming, but the moment that it fails on the fourth candle to run above these buy stops, you have to know that we're back in a continuation market to the downside and price drops aggressively. Okay, so one thing I want to say before we go into the intraday timeframes is we can never predict the volume of a move, but we can understand what it's likely to do when IPTA is giving us the signals. It's like a big billboard in your face saying, fair value gap, sell me here, buy me here. You can't miss it. It's a big billboard. What you need to know is when is price that is imbalanced become rebalance after liquidity is taken. And that's why I posted this video today. I want you guys to see a little snippet of how I actually go about determining imbalance, rebalance, and purges of liquidity. Okay, this is all external trading here that we're talking about on the daily time frame. When you go into the intraday time frames, there's still external liquidity, but you're basing that framework off of the daily framework. So when you go on to the 1 hour, you're just adjusting what you already have on the daily. These lines and boxes will appear on the intraday time frames, and you'll see more information that gives you basically the intel you need to get into your trades. Because remember, Good Eats FX is about analysis, framework, and execution. All right, guys? So we're going to go ahead and go into the intraday time frames. But before we do that, I want you guys to take a minute to go back and review before we go into that next video on intraday time frames. Until then, I'll see you in the next video. Let's go.